All right, we'll continue to monitor the market reaction to this. Switching gears, Procter Gamble beating estimates on the top and bottom line in the latest quarter as high prices offset lower demand for its products. The company also raised its full-year forecast. Yahoo Finance's executive editor Brian Sozzi sat down with the CEO, John Moeller, earlier today, who said the consumer remains resilient. Take a listen.
We had a great quarter from a top-line standpoint, as you're indicating. Over 7% organic sales growth, every category growing. Both of our major regions, the focus markets and the developing markets, growing 5% and 15% respectively. But underpinning that is a degree of consumer resilience, but there's also a degree of intentionality in how we've structured this portfolio and executed our strategy, which is based on continuing to innovate to improve the superiority of product, package, communication, our go-to-market execution, value for consumers and customers. And as we bring innovation to the marketplace, the value proposition, inclusive of performance, increases. So we haven't been standing still in terms of what we're offering consumers. At the same time, we've built what we refer to as portfolio ladders, giving consumers the opportunity to trade down within our brands if that's relevant to them. So you can buy Tide Power Pods at 50 cents per load. You can buy regular Tide Pods at 30 cents per load. You can buy Tide Simply Pods at 20 cents per load. So we've tried to be very, very intentional and consumer focused in maintaining and increasing the value that we're offering to her every day.
Has P&G, just given the focus with consumers on finding affordability down the shopping aisles, has P&G had to come out with more entry-level products?
As I indicated, over the last number of years, we've been filling out our portfolio in that regard. We've also been very intentional on ensuring we have pack sizes that are designed for low cash outlay capability. We've ensured that we're present in a relevant way in the channels that typically benefit from any kind of a downturn. But, in terms of this being a major descriptor of the environment today, that's not what we're seeing. If you look at private label shares as a proxy of trade down in our categories, they're up very modestly, 0.2 points in the U.S. past 3, 6, and 12 months. And at the same time, we've been building share. In the quarter we just completed, we were up 0.4 points in terms of value share, up 0.9 points in terms of volume share, growing the U.S. business 6%.
I've talked to a few consumer-oriented CEOs recently, John, and they are calling out, their words, not mine, stress on the lower income shopper. What do you see with your brands that touch that consumer?
Again, we see consumers across the pricing spectrum define value in a very comprehensive way. Price is an important component of almost everybody's value equation, and certainly more of a component at the lower end. But so is performance, so is aesthetic, so is usage experience, so is the sustainability of the offering. And all of that comes together to inform brand choice. We've intentionally designed our category to focus, our portfolio on categories where brand choice is driven predominantly by performance. And so we're not seeing a lot of trade down. We're seeing, if anything, more careful usage of the product that I have bought. So I might use a half a sheet of a Bounty paper towel as opposed to a whole sheet. But generally, again, just look at the numbers. The consumer is holding up extremely well, and part of that reflects our service of him and her.
Let the record show, John, I remain a full sheet type of guy for Bounty. I just wanted that to be known out there on the interwebs on your earnings day. Two businesses that stood out to me on an operating profit level: fabric and home care, operating profits up 21%. Baby, feminine, and family care up 11%. Unpack those gains for us. Is it price driven? Because those are some of the biggest gains you saw in the quarter from an op profit line.
We're making good progress in recovering significant commodity inflation and significant foreign exchange impacts, both of which hit that margin line. And we're doing that through a combination of pricing, as you indicate, mixing up to higher value, albeit premium products, and a significant continued focus, steady focus on cost productivity. And those categories, if I were to unpack each of them, you'd see those components carrying the day. The team, if you look at the last 2 years, we've had to overcome, and the team has more than overcome, $7 billion after tax in the impact of commodities, foreign exchange, and transportation costs. That's 50% of our earnings. Last year, we grew earnings per share. This year, we're forecasting modest growth as well, while maintaining investment in that very strong top line, expanding our margin of superiority, growing markets, getting to more households and improving their lives.
Called out within the guidance, John, $2.2 billion commodities hit. I think that sounds pretty around the same lines of what we saw from P&G when we last spoke on the last quarter. But as you look forward out over the next 12 months, given we have seen a pullback in a lot of commodities, how does that pullback impact your bottom line? How do you anticipate that playing out?
Hopefully positively, but we're still very early in understanding our plans and developing our plans for next year. And there are other things that I think you'll readily appreciate are going the other way. Things like labor cost, things like interest expense. So we'll have to net all that together. But I expect us to continue to face significant challenges from a macro standpoint for the foreseeable future.
And then on those macro challenges, to be clear, you're not seeing anything in your business right now that a recession is imminent or a sharp economic slowdown?
We are not.
Okay. And then lastly, we're asking all leaders, John, of your stature. It's been a weird time in the economy. I mean, in March, we saw bank runs, people outside of banks trying to get their money out. I've never seen anything like that before. A lot of the leaders that I talk to, they haven't seen that too. To the extent you could, bring us inside the C-suite. When you saw those things happening, what did you tell your executive team? And how do you manage through a crisis like that?
Well, the great thing about our strategy is that it is relevant and good in a good economic environment. It's equally or more relevant in a difficult economic environment. So the superiority of products, again, product package, communication, go-to-market, good value for consumers and customers. You would want that in a good economic time. It's critical in a difficult economic time. A focus on productivity and cost control, very helpful in a good economic time, critical in a difficult economic time. So we're really trying to stay focused on what we can impact and deliver. And if we do that well, we'll be in the best shape we possibly can be, whatever that looks like. And if we don't, whether it's a good economic environment or a difficult economic environment, we won't be. So the focus is clear, it's steady, constant, and the team is doing a brilliant job of executing against it.
John, real quick, just to tap into your former CFO mind. I mean, on days like that, are you calling the banks? Like, what is your day like?
I'm calling our CFO.
And what advice do you give him as someone that was in that seat? What do you tell him?
Well, he's perfectly capable of. He's a great talent and is doing a super job. So there's not much I need to tell him. I'm more just offering my presence and perspective, if he would find that helpful, given having gone through 2008 as treasurer, and then, as you mentioned, for 12 years after that as CFO. But I'm focused primarily on those kinds of days on just continuing to advance the strategy. And a company like Procter Gamble, while with its credit profile, generally shouldn't get overly exercised with minor moves within the credit market or in the things that affect the credit market. We'll be just fine. That was the case in 2008. It's the case today.